Well, a major tremor just ripped through the Asian markets. Today, February 6th, we saw a pretty significant plunge basically across the board. So we're going to dig into a detailed analyst report to understand what exactly happened, why it happened, and what the data is telling us might be coming next. Let's get right into it.
To really get a sense of the shock today, you only need to look at this one number, a staggering 3.71% drop in Korean KOSP futures. I mean, wow. That is the kind of move that gets everyone's attention, and it really set the tone for a very, very rough day.
And here's the final scorecard when the dust settled. The Korean KOSPI down 1.44%. The tech-heavy KOSDAQ got hit even harder, down almost 2.5%. Over in Hong Kong, the Hang Seng also took a serious blow, dropping 1.21%. Now, what's interesting is that mainland China held up a little better, but you can see that red, negative sentiment was definitely in the air everywhere.
So what on earth triggered this whole cascade? Well, the report we're breaking down points to two big external shocks that basically rattled the markets from the outside in. These weren't homegrown problems. Think of them more like global tremors that caused some major regional aftershocks.
Okay, so on one side, you've got what the report is calling the Warsh shock. The new U.S. Fed Chair, Kevin Warsh, basically signaled he's going to be much more aggressive about tightening the money supply. And that, of course, sparked immediate fears of a global liquidity crunch. Then, on the other side, you have major U.S. tech giants saying they're going to cut back on spending for AI hardware. And that's a direct shot at the Asian semiconductor giants. It was really a classic 1-2 punch of monetary policy fear and tech sector anxiety.
But just knowing the catalysts, that's not really enough, is it? The report goes deeper, and it uses some pretty powerful economic theories to explain why the reaction was so violent. This isn't just about the news, it's about the market's psychology. So let's peel back that layer.
So first up is this idea of collective foolishness from Gunter Dueck. The theory basically says that at some point, group panic just takes over and completely overwhelms any kind of rational thinking. The perfect example today was Samsung Electronics. The company literally posted earnings that beat expectations, which is great news, but the market totally ignored it. Instead, everyone panicked over a single piece of news about a potential supply delay. It was a textbook case of fear just going viral.
Next, the report brings in this concept from the Austrian school called malinvestment. The theory is actually pretty simple. All that super cheap, low-interest money that flooded the market in 2025, it led people to make some, well, let's just say misguided and risky investments. Now, with the Warsh shock signaling that the party's over, those investments are being painfully and forcibly sold off. It's kind of like the market is cleaning house, getting rid of the excesses from the good times.
Now, this next theory really helps explain what happened in Hong Kong. The report uses John L. Casty's theory of social mood. And this one's a bit of a mind-bender. It argues that the market doesn't just react to events. The underlying social mood can actually create the events. So from this point of view, the sell-off in Hong Kong wasn't caused by any single piece of news. It was really just an expression of a pessimistic mood that was already there, just waiting for an excuse.
This brings us to a really crucial point from the analysis, one that lines up with how great investors think. The idea is that we're not yet at that stage of extreme fear that often signals a true market bottom. You know, that thinking captured by the classic quote, "This time it's different." It suggests that while the names and dates change, these patterns of fear and greed, they just repeat. So while the anxiety today feels very, very real, the report argues we might not have seen the worst of it just yet.
Okay, so that's the diagnosis of what happened today. It's this complex mix of outside shocks and some really deep-seated market psychology. But now for the question I know everyone is asking, what happens next? For that, let's turn to the report's purely data-driven quantitative forecasts.
Right, the big question. Where do the markets actually go from here? To answer that, the report doesn't rely on anybody's opinion or gut feeling. Instead, it uses thousands of computer simulations to map out the most probable paths forward for the rest of this month.
And here's what the computer spit out. Using a Monte Carlo simulation, the report projects a really wide range of possible outcomes. For the KOSPI, you're looking at anything from another 4.7% drop to a 3.2% rebound. And look at the KOSDAQ. It's even more volatile, with a potential downside of over 9%. These wide ranges really just scream one thing: uncertainty. To help you see this a little better, just look at the KOSP forecast. Today's close at 5,089, it's sitting right in the middle of this huge predicted range of volatility.
The model is showing there's a very real chance we could test those lows down near 4,850, but it also leaves the door open for a pretty significant bounce. The key takeaway here is that you gotta be prepared for sharp moves in either direction.
Okay, so given all this volatility, how might someone even begin to navigate it? Well, the final section of the report lays out a quantitative trading framework. Now, I have to be perfectly clear here. We are explaining the strategy detailed in the source analysis. This is absolutely not financial advice. It's a fascinating look into a systematic, rule-based approach to trading.
So this framework is built on 4 pillars. First, you control the volatility. If the market gets too wild and choppy, the system automatically pulls back on risk. Second, you make a relative bet. Instead of trying to guess the whole market, you play one stock against another, like betting that Samsung will outperform Nvidia. Third, you watch the currency. Use big swings in the Korean won versus the US dollar as a trigger to rebalance your assets. And finally, number 4, you protect against a total disaster by using a small slice of the portfolio, about 5%, as insurance against a major market crash. You know, the entire point of a framework like this is to take human emotion, the panic, the greed, that collective foolishness we talked about earlier, and just take it right out of the equation. It's all about replacing those gut feelings with a disciplined, data-driven system that's actually built to handle the chaos.
And that leaves us right here with the central question posed by the report. Is what we saw today the beginning of a painful bubble collapsing, or is it the start of a necessary, maybe even healthy, rebirth for the entire system? The data suggests we are at a critical fork in the road, and the path we take from here is really going to define the next chapter for these markets.